Some more perspective now. Shankar Sharma of First Global is with us now to talk about how he sees 2010 starting off. Morning, Shankar. Good to see you again. Before we start off on markets, perhaps you can give us your thoughts on what you've made of this trading extension to 9 o'clock.
Yeah, I was planning to retire by the middle of 2010. It seems I'll have to retire on January 3rd now because, I am not at all a morning person. I find it extremely hard to get up even at 8 o'clock, and to make it to office by 9 is, in fact, 8:45 is impossible. So, count me out on corporate radar from January 4th at 9:10. It's not going to happen. So, I think it's absolutely asinine, absurd move. And what is shocking is it's completely undemocratic. I mean, the biggest interest group in the markets are brokers, right? They are the guys who should be making the decision on whether they want extra business or not. Stock exchanges are not, they might have become for profit in a manner of speaking, but essentially they are there to provide a service. They are not there to really make money. So for them to chase higher volumes, somehow it doesn't sit right. Brokers should be chasing or making a case for higher volumes. Why are stock exchanges so interested in increasing their volumes? I mean, to the best of my knowledge, National Stock Exchange is never going to do a listing, and the Bombay Stock Exchange listing, I think, is going to happen probably sometime in 2020 by the looks of it. So I don't understand that the guys who are most interested in increasing volumes, which are brokers, 70% of them have had thumbs down on this proposal, and yet the stock exchanges, in a manner more reminiscent of Hitler's Germany, decided that no, this is it, and just take it or leave it. I really pine for the good old days of the early 90s or the 80s when brokers would have gone on strike. That's really what is required today. Unfortunately, brokers have been emasculated by, the emergence of a regulator, which back in the 80s didn't exist. But this is, in a democracy, a dharna or a strike is a legitimate tool, and I really think this is something that requires the finance minister's intervention. This is not, you can't increase rate timings and call yourself Singapore. It requires a lot more than just increasing an hours of trading to become Singapore, right? People will have to start, coming to work, leave their home at 6 a.m. to make it in time for 8 a.m., into office. In most Indian metros, I don't think you have a commuting time of less than an hour and a half for most people, unless you are a fat cat. And I think a lot of the stock exchange people are very, very well paid. I mean, amazingly well paid. So they probably live two minutes away from their stock exchanges. But 90% of the people involved in the markets are nowhere that close. I just don't see where this is going to go. It makes no sense whatsoever.
Shankar, morning. At the pit of your stomach, though, do you think they will still go ahead with it anyhow?
I mean, I'm a big believer in democracy, but I do believe that as far as stock markets are concerned, there is no democracy. It's a pretty dictatorial regime. Take it or leave it. We saw exactly what, the way it panned out. I do hope that, some sense prevails amongst the administrations of the stock exchanges, and they say that, look, this is not a wise move. And if the biggest interest group, which is brokers, they are not in favor, then who are we to say that, start at 9? And if you want to take away the SGX nifty volumes, then why stop at 9? Then let's go to 7 a.m. I mean, this is absolutely, ridiculous. I don't see what gain you will get, because I don't think the SGX volumes, look, the reason for trading on the SGX is not necessarily just the fact that it opens early. I think it is also to do with the fact that, you have lower sort of barriers to entry by way of an investor. Lower taxation, a lot of other factors, not just the fact that it opens earlier than the Bombay Stock Exchange or the National Stock Exchange does. So I do hope, they do become democratic, take into account the popular sentiment, and, put this, away for a long, long time.
The market's been just trading a very, very narrow 2% range, 2-3% range since October, Shankar. No sign of a breakout or a breakdown, to be fair. How do you think 2010 opens up then?
You see, what's happened, let's just simply put this in context. What's happened to my reckoning is that last 2.5 years, if you go back to the middle of 2007, from that point, markets have had really unprecedented levels of volatility. And if you just look at the VIX, a VIX of 2021 back in the old days used to be considered very, very high. Now it is considered the base. by way of volatility. So just that simply tells you that how far volatility climbed in the last 2.5 years. We've had 60% down year in 2008. We've had a 50 or 100% up year in 2009. I just think that to expect markets to continually be in a state of volatility, and that's great for traders, we all welcome volatility. We probably have had the volatility that we could handle, and markets gave us more than what we should have actually gotten. So we were, in a manner of speaking, quite lucky that we got so much volatility compressed in such a short span of time. People got huge opportunity for profit, both on the short side and on the long side, all in a matter of 2 years. You saw a market run up 100% in less than 6 months' time, which is a return that you would expect over 2 years of a bull market. You saw a market crack 60-65% in a single year, which ordinarily would probably never happen, but even if it were to happen, it should have happened in 2 years instead of 8 or 9 months. So I think given the background of that volatility, you're probably settling into a period of, a little bit of a nothing kind of market. And that, I think, is why just October. I think markets have been struggling for the last 3 or 4 months. You're talking a 3% range. I could go back right to the end of the budget, to the end of the elections when markets hit 15,000. And from there, by and large, there has not been a huge amount of movement, barely a 10% swing either way, which is nothing in context of India's own volatility history. So I think we are probably just settling into some kind of a period, but I dare say my sense is that cozy consensus of low volatility will probably break down in the next three months' time. Probably, around budget, a bit beyond budget. I think this may well give way. So my sense is, markets may hang in there for a while, but 2010 is going to be a lot rougher for the bulls than it has been in 2009.
So this range-bound move is a half full or half empty situation, Shankar? I mean, is it a market that's consolidating to, garner some more strength, or do you read it as a sign of weakness?
If you put it in context of what happened back in February and early March 2009, there was a lot of bad news, but at least the emerging markets part of it refused to go down. And we saw that while the US market did make a low, emerging markets never made the lows that they made in November. They were never retested, despite a lot of bad news. My sense is it's on the exact reverse side, that you're seeing a lot of good news, but markets are struggling to take out, their earlier levels. India has had very good numbers by way of GDP. I don't know from where they sort of spun out those numbers, but be that as it may, let's trust them for what they are worth. They were eye-popping numbers, to say the least. China has been doing phenomenally well. US employment data has been pretty good. So by and large, if you see, the numbers globally have been quite good, but markets globally have been struggling. The S&P was, about 950 or 1,000 back in July, and it is about 1,100 now, which is again a nothing kind of move for the last 6 months. That gives me the sense that markets are anticipating that the best part of this move is over. The cozy combination of low inflation, low interest rates that prevailed through most of 2009 is winding its way down. The world will probably exit to some degree the stimulus packages over the course of 2010. And most importantly, I think inflation, which the last time I was on the show about a month back, I saw that as the biggest threat, and I continue to see that as the biggest threat. Not coming so much from industrial commodities, but coming from agri-commodities, which I think are an absolute tier globally. I'm very bullish on those. Given that, and given the weightages of food in most emerging market inflation baskets, you're going to see inflation in emerging markets actually be an absolute tier compared to inflation in the developed markets. And given that, I see rates hardening in EMs a lot more than they harden in the US, which will really pressure emerging markets equities vis-a-vis US equities. So I think that's a trade that probably is setting itself up, which will play itself out through 2010, that EMs underperform US equities.
Just on that point, Shankar, this interest rate hike phenomenon, or the trend, started in the end of 2006 once, and their growth was picking up. 2006 end December, RBI moved through 2007, and the Nifty kept on moving along with it. The interest rate hikes never stopped the market. The Nifty was up 40 to 60% through 2007, and the RBI moved some 6-7 times. Why do you think this time could be different, that the market may not rally even as interest rates are going up as they did in the last bull market?
You see, in economics, what happens is things are never arithmetical. So you cannot ever add 1 plus 1 and it should equal 2. So raising interest rates should lead to a stronger currency, but you've seen many times raising interest rates. Sometimes, in fact, quite often is accompanied by actually falling currency. So it's never arithmetical. Back in 2006, you were still in the middle of a huge expansion on pretty much all macroeconomic parameters, except for one, which was inflation. So inflation was pretty subdued. So we did not really have a problem on that front, which is why I think markets, did reasonably well. And the moment you actually had high inflation back in the middle of 2008, you saw what exactly happened. So I think the real issue is going to be inflation more than just the hardening of interest rates. Because in India, in any case, I have never found that, the retail rates are that heavily correlated with what the RBI policies are. I mean, the cutting that RBI started, again, did not result in a huge downdraft on, the rates at the ground level. You could still access FD rates at pretty decent yields. So it's not really a one-to-one relationship at the street level in rates what the RBI initiates at its own policy levels. So more than a rate tightening cycle, I really fear inflation is going to be the real bugbear for the markets. And up to a point, inflation is great. So nobody will mind 5%. But I see simply because you had a huge base effect positive coming in 2009 because of a high 2008. You will have the exact reverse of that playing itself now. So you could be north of 10% very quickly, maybe by the first quarter of 2010, and that the markets will not like. And that is going to be led, like I said, by agri-commodities globally. So, your rate hike in a bull market they necessarily don't crimp a bull market. But a rate hike in what we are in right now, which is still a fragile level of global recovery, can act in a pretty divergent manner as compared to what happened in 2006 or 7.
Stay on, Shankar. Just need to take a quick break. We'll be back in a minute. The market